If anyone would know, it would be FedEx. And the company just said that it sees tremendous weakness building up in particularly the U.S. economy. While markets are shuffling back and forth between the latest trade wars pronouncements, the data that comes in is aligning with what FedEx is seeing and saying, along with what we're seeing in the U.S. dollar exchange value. So stocks go back and forth in the latest big news when the underlying data, the stories from businesses, the earnings reports, and these financial markets is going in another direction. And it's not trade wars. It's the loss of momentum in industry and manufacturing that is spilling over even before we get to them. What FedEx and the goods economy are picking up is the payback, and we can already see it, and so can they. We're also getting the price part of it too. Input costs have gone up, which is hammering businesses all over again. These recent reports show that firms can't pass them along to customers or the companies further up the supply chain. That's not inflation because the demand isn't there. So there's less demand for services like those provided by FedEx. So while margins are being squeezed and everyone is talking about jobs, and from this perspective, you don't want to hear employers talking about jobs. Higher costs, falling sales, a huge degree of, yes, uncertainty on top. This is why the R word has made its unwelcome appearance in a whole lot of different formats. So there's a lot to go over today, a lot of ground to cover. So let's get into what FedEx reported, which was lower earnings expectations, lower sales expectations for this year. High degree of uncertainty, but it's not really that much uncertain. The company announced that third quarter EPS grew by 17%, while sales totaled $22.2 billion, increasing around 2%, which isn't great compared to a year ago. Now the company moving forward expects flat revenue growth after a year where it had minimal growth to begin with. Compounding problems, it's not trade wars, it's lack of demand. The industrial economy, the goods economy is not picking up even before we get to 2025. It continues to go in the wrong direction, and FedEx is uniquely positioned to tell us that's the case. They have information and insight into a whole bunch of areas inside the US as well as outside. And what they're seeing is growing weakness, they call it uncertainty, growing weakness in the industrial economy when it was supposed to be picking back up and going in the other direction. So revising revenue to flat for this year is already a concession that the weakness is more than pronounced. It's even more than it was last year, and last year was not a good one. According to CNBC, Chief Financial Officer John Dietrich said, "Our revised earnings outlook reflects continued weakness and uncertainty in the U.S. industrial economy, which is constraining demand for our business-to-business services." And that's where FedEx makes a ton of money, when businesses have to ship things back and forth between themselves in order to make other things. In fact, that's one of the weak points that they pointed out, was that FedEx is seeing that the demand for capital goods that make other goods has gone down too, because what that suggests is that businesses that make things are seeing less demand for their things, so they don't need as much things to make the things that they sell to everyone else. As CNBC put it, the industrial sector includes firms that produce products used to make other goods. It drives significant cargo volume and more profitable deliveries for FedEx as well as UPS. Many executives in the U.S. transportation industry had been banking on the industrial economy turning to growth this year, but those hopes have been dashed. And so when capital goods spending and therefore capital goods shipments decline, as FedEx is saying, that's not a good sign about optimism among producers in the real economy. They're not seeing a pickup in demand outside of maybe the transitory demand that picked up last year, and now we're into the payback period. That's what FedEx is really talking about with its uncertainty, not really trade war and tariffs. It was the artificial high in demand last year that created an artificial high in activity that has to be paid back, because all it was doing was pulling forward a whole bunch of stuff into the end of 2024. And all this is going to impact the global economy, of course, and that's something I just went over in a webinar I just finished up a couple hours before recording here. A replay of that webinar is available. There's a link in the description to sign up to get that. Went over the global implications to the potential shifting of the pattern in the economy from forgot how to grow to maybe something else. But also talked about why the forgot how to grow economy, if it continues, would actually be the worst case, and how maybe a 2008-ish contraction might be the best case, or at least lead to the best case. talking about scenarios and game planning, the global implications to everything that we're seeing now, the potential inflections and shocks in early 2025, and what they mean for economic observers, everyday people, as well as investors. What do you do in each of these scenarios? There's a link to the replay of that webinar in this video description. And it wasn't just FedEx either. There's been other corporate announcements that have continued to talk about especially uncertainty, but uncertainty as it relates to consumers and their fears over the jobs market, not necessarily related to tariffs, but the fact that the jobs market was weak, especially in places like Canada. There was another company called Lightspeed Commerce, which just today, the Montreal-based payments company, Chief Executive Officer Dax De Silva announced that they were cutting their revenue guidance. And what he told Bloomberg TV was, several macroeconomic conditions have deteriorated in that time. Again, through February and March to date. That's the time period we keep coming back to. We've seen heightened inflationary pressures, more job insecurity, and there's just been weakened consumer confidence that's been impacting discretionary spending amongst consumers. Everything that we've seen and talked about here in the United States, you obviously see the same stuff in Canada, and to an extent in Europe and other places around the world. Loss of momentum. That's what FedEx is talking about. They call it uncertainty. That's what Lightspeed is talking about. They call it uncertainty, but it's uncertainty about jobs and incomes, not necessarily related to tariffs, but the weak fundamentals in the economy that are playing out with the potential for tariffs to make it that much worse. That's why the US dollar continues to go higher overall, though you hear a lot of chatter nowadays about how the dollar has weakened, when in fact it's weakened against currencies like the euro, in particular the euro, based on the Berlin stimulus package that was announced earlier in March. Suddenly the euro picked up a bid, the US dollar was weaker against the euro, and since the euro is the majority of DXY, and DXY is the index everyone uses to describe what the dollar's doing, so DXY was weaker against the euro. So DXY was lower than it was in other formats. The US dollar looked lower because of DXY. You look at the US dollar on a trade-weighted basis, for example, not only did the dollar get stronger and higher over the last part of last year, it remains stronger and higher even on a little bit of a downswing fluctuation so far in 2025. And a higher, stronger US dollar is not height in the US economy nor strength in the global system either. A stronger, higher US dollar is a negative sign for the entire global marketplace. Higher risk aversion related to concerns, not uncertainty, concerns over where everything is heading. Even before we get to trade wars and tariffs and all the restrictions and possibilities, uncertainty that everyone is talking about. They're really using that term uncertainty to describe what the dollar already has for much longer than the last several months. And you see it against individual currencies too, like China's yuan. That's moving back down to 7.25 to the US dollar after being relatively strong on hopes that perhaps the US and Chinese would work out their differences and they could avoid some of the worst parts of trade restrictions. You see JPY, for example, Japan's yen is back under 150 to the US dollar as well. A little bit of weakness there despite what are favorable short-run interest rate differentials, not to mention some other factors. And then there's other currencies like Korea's won. It's moving back toward its lowest value at the end of last year. And it's already not that far from it at 14.69 to the US dollar. And it's been moving downward really since February 24th. So we're talking about an entire month of weakness in Korea's won, which like the Japan yen when it's weaker and China's yuan, all of them suggesting not trade wars, but the implications of a global economic condition that continues to go in the wrong way, the tremendous loss of momentum, and how that might play out specifically with Asian industrial economies. Nowhere good, that's for sure. The updated figures that we got this morning were for S&P Global and its various partners around the rest of the world, PMIs, US, Europe, Japan, suggesting basically the same thing. Well, the US PMI for the services sector rebounded in March from its February low. That looks to be, especially given the details behind the US services PMI, that looks to be nothing more than a short-run fluctuation. And the drop last month was more reflecting of the shift in the loss of economic momentum in the US economy. And S&P Global's US services PMI tends to be the high outlier to begin with. So it's always looking at the US economy, services economy, from the most charitable perspective. And you contrast that really with other data on the services sector from, for example, the Federal Reserve's regional services PMIs that are now rolling over and falling. It suggests, again, the rebound in the services PMI from S&P Global, not likely to stick around very long. But the manufacturing index, that one is back into contraction, down from a 2-year high, because this is exactly what we've been expecting. The give back, the payback period for all of that artificial activity last year, especially in manufacturing, production, and trade, has already begun. According to S&P Global, that one fell back below 50 for the first time in a couple of months, down at 49.8. But what they also said was jobs growth was also subdued amid heightened uncertainty about the outlook and concerns over rising costs, because manufacturers, like any other business, they can't pass them along. Input price inflation accelerated sharply, especially in manufacturing, to a near 2-year high, often attributed to the impact of tariff policies. However, and I love this part, competition limited the pass-through of higher costs to selling prices. What they're basically saying is demand wasn't there, and because customers had the option to look at other competitors, no one could raise their prices. So their input prices are going up for a variety of reasons, especially tariffs. Suddenly, they can't pass those costs on to either consumers or other businesses in the supply chain. So what are they going to have to do? They have to cut their costs. Either they have to take the hit or they have to cut their costs someplace else. And where are those other costs that they're going to be trimming? That's labor market. That's fewer hours, maybe even fewer workers. Even optimism took a huge hit, according to S&P Global. The decline took confidence to its lowest since October 2022, barring the nadir seen last September when business was unsettled by uncertainty over the U.S. presidential election. On one hand, sentiment about the future of manufacturing remained among the highest seen in over the past 3 years, which factories commonly link to hopes for stronger demand amid supportive trade and other policies, such as low taxes, but they're starting to see that sentiment roll over because it's not living up to the hype. On the other hand, according to S&P Global, service sector confidence deteriorated for a third consecutive month, sliding noticeably from December's 1.5-year high to its second lowest since October 2022. Sentiment is rolling over too. It's just rolling over faster in services because manufacturers are holding out hope that this manufacturing trade restrictions, tariff stuff will lead to better business, at least in the intermediate term. They're hoping to get through the short-run pain and come out better on the other side. Yet, as S&P Global mentions and other sources beside, manufacturers are starting to become more and more uneasy about the optimism that they've been maintaining really since last fall. The effect of the presidential election, as well as rate cuts and a whole bunch of others beside, that the boost of activity at the end of last year really was transitory. And then you get to the real stuff, employment. As the press release continues, even here, the rate of job creation was marginal and much weaker than at the turn of the years. Loss of momentum. Some companies reported job losses due to sluggish demand, plus a wariness to hire due to the uncertain outlook. Manufacturers in particular reported concerns over payroll numbers and rising costs, cutting headcounts for the first time since last October. Basically everything that I just said. Manufacturers were hoping for a renaissance and a rebound, and instead they got a temporary one and not much else beside. Now they've got to make big decisions because input costs have gone up, and they have to do something about them. And something they're going to do about them is more negative impacts on jobs and incomes. Exactly the thing that consumers are worried about. And as consumers get worried about jobs and incomes and then get problems in jobs and incomes, consumers might pull back in spending, which is something we already talked about and saw with retail sales. And on it goes in the vicious cycle of the traditional recession. There have been similar processes taking place over in Europe as well, as S&P Global reported for their PMIs on the European economy. Overall business activity rose for the third month running. However, companies continue to see new orders decline at the end of the opening quarter of the year. New business in the Eurozone has now fallen in each of the past 10 months, with the pace of the reduction little changed since February. So they continue to see falling sales. New orders were down across both manufacturing and services, although the drop in the former was the least marked in the current sequence of contraction that spans almost 3 years. In fact, the European manufacturing PMI rose to its highest level since early 2023, which sounds great, but it's still below 50 at 48.7. So it's the least amount of contraction in a couple of years, and largely because of all the same artificial distortions that we just went over for the US economy, meaning that Europe, which never really got all that much of a boost, is also going to experience some degree of payback as well. And with firms holding employment broadly steady in March, they were able to keep on top of workloads and therefore depleted outstanding business. Backlogs of work have now decreased on a monthly basis throughout the past 2 years, with the latest fall being solid and the fastest in 4 months. And that's not a good sign either. Payback, payback, payback over in Europe, as well as Japan. Japan is experiencing its own form of the same things, which is why I went over the stronger dollar against especially Asian currencies. According to S&P Global's partner, Jibun Bank, at 48.3 in March, the headline flash Japan manufacturing PMI slipped from 49 in February and signaled a deterioration in manufacturing sector conditions for the 9th successive month. Though modest, the rate of decline was the quickest seen in a year, with firms registering steeper falls in both production and new orders. New sales, that's a big one. As a result, companies cut back solidly on purchasing activity and continue to trim their inventories. And there's your payback from the Japanese perspective as well. It's exactly what FedEx has been saying. We can see softness in the marketplace because there was a little bit of activity last year. In some places, there was a lot of activity trying to get ahead of tariffs. But once that was done, what happens? Tariffs increase the cost of the entire supply chain. At the same time, suppliers realize they can't pass those costs along to anybody because it's not inflation. It's only more non-economic impositions that lead to disinflation, demand destruction, and further weakness. What FedEx calls uncertainty. And FedEx is not the only one to call it uncertainty. Everyone is calling it uncertainty when there's less uncertainty in it than most people seem to realize. So we keep getting these reports from all over the place talking about, whether they use the terms or not, talking about loss of momentum in the real economy. So what we're really talking about here, as they talk about loss of momentum and uncertainty, is the forgot how to grow economy perhaps transitioning from forgot how to grow style recession into something that looks more like the traditional type, where you get negative GDPs, negative payrolls. You get into the vicious cycle where consumers pull back in spending because they're uncertain about jobs and incomes, which leads companies to pull back on jobs and incomes, which leads to consumers pull back on spending. The self-reinforcing vicious cycle. That's what everyone is worried about, and we're starting to see more signs of it. Not conclusive signs, not definitive signs, but a rising probability of moving from forgot how to grow to remember how to recession. We aren't quite there yet, but the chances continue to rise as each and every one of these corporate reports comes in and more data comes out. One of those signs is small cap stocks and the behavior of small cap stocks and investors' appetite for them. They tend to be a canary in the coal mine. We talked about that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Check out the replay of the webinar, link in the description. And until next time, take care.